Building your equity value and using your equity, unfortunately or fortunately, is one of the most complex things a founder has to do. We don't have a finance background or a legal background, but you've got to use it when you're raising. You've got to manage your dilution. You want to maintain enough of it. You need to use it for your team. It's just a major part of being a founder and a startup.
Listen up, everyone. Great startups are built with great people, and there are great people everywhere in the world. But have you ever thought of all the headaches that hiring a global team can create? Entities, compliance, payroll, equipment, provisioning, and more. You're here to build a great startup, not become a global HR expert. But don't give up on the dream. Our sponsor, Deal, is an all-in-one HR platform specifically built for global teams. All those problems instantly solved. Learn more at deal.com/TSP. That's DEEL.com/TSP for the Startup Podcast. We know how hard it is to find and afford the A players who will help your startup succeed. But don't despair. Instead, talk to our friend of the pod, Until Now. Until Now gives you access to top-tier fractional experts, so you don't have to settle. I've worked with these folks at Airtasker, and they're behind the rebrand of this very podcast. They are the real deal. Check out their work and get in touch at untilnow.com.au.
You're listening to the Startup Podcast, a show focused on helping you build, run, and invest in Silicon Valley-style startups. Whether you're an investor, founder, or operator in a startup, you'll gain insights on the principles that power high-growth disruption the way Facebook, Google, and Uber do it. The conversation starts now.
Hey, I'm Yaniv.
And I'm Chris.
And I'm Jason.
In today's episode, we're discussing the topic of employee equity, what it is, why you should offer it, and how to set up an employee equity scheme. To help us make sense of this really important but quite complicated topic, we have a very special guest. Jason Atkins is co-founder of Cake Equity, a company that is devoted to allowing startups everywhere to painlessly set up delightful employee equity schemes. Jason, welcome to the Startup Podcast.
Hey, thanks for having me, guys. Great to be here.
Great to see you, Jason. And by way of disclaimer, guys, I'm actually a shareholder and former advisor to Cake, so we thought we'd mention that at the very top of the episode, but we are not being paid or sponsored to do this episode. It's actually a really, really important episode and a really important topic. So thanks for being on the show, Jason.
No, great to be here. Amazing how far we've come, in the last 4 or 5 years since we worked together. You must have a really unique position thinking back to the early days.
It's really great to see how far you guys have come from those early conversations about let's do one thing really well and let's pick a hard problem and solve it. And you've certainly solved a hard problem. So congratulations to you guys. Jason, let's start at the very beginning. Tell us a little bit about yourself and also what are employee equity schemes?
Yeah, it's a bit about me. When I started Cake with Kim and Johan about 5 years ago, I was mid-career. Like a lot of us were like, how can I have the biggest impact? How can I do something meaningful? How can I get out of the grind? I was pretty passionate about innovation, entrepreneurship, and its ability to help solve problems and create a better world. And so we first stumbled onto the cap table problem. It's just a hectic thing. Unfortunately, founders, they have to use their cap table in the beginning with founder equity, and then when they're raising and employee equity. And when we saw how hard a problem it was to solve, it felt like something really meaningful to dig into. My co-founder Kim is super passionate about innovation, entrepreneurship. So it felt like something we could invest a big chunk of our careers into. And thankfully, that's been going really well. And then what is employee equities? It's giving everybody on your team a piece of the cake. We don't want to see the next Atlassians coming through or the next safety cultures coming through and the team's not benefiting. We want to see everybody benefiting from these massive outcomes. And so we try and make sure that everyone who helps build a startup has a piece of that startup and that we can all share in the success.
So just to put a very fine point on that, right? When you think about the stock market and you buy shares in a company on the stock market, you are buying a piece of that company. And you're able to do that because they've listed their shares on the public exchange. You can go and buy some. When you have a private company, it's not on the stock market. You can't just go and buy some. But the company can still issue shares privately to various stakeholders. And it is really common practice in Silicon Valley, very common. In fact, it would be weird to see a company not doing this, for a company to say to its employees, well, part of your compensation package is cash, and part of it is an ownership piece in our company. And to participate in the value creation of the company, participate in the company's worth growing and growing and growing. Because the expectation, of course, for a startup is that company's value is going to be rapidly increasing in very short time frames. And so you, as an employee of a startup, want to join great startups that are growing really fast. The value of those companies are growing really fast. And if you own a piece of that company, you will bleed, sweat, and cry to work really hard to contribute to the value creation, and it really drives alignment and it drives wealth creation for the ecosystem. So that means that you mentioned Atlassian, Jason, the employees of Atlassian didn't get to participate in the success of Atlassian. And so they're not able to walk away with some amount of money and to reinvest in their local ecosystems. So that is really the whole idea of owning a piece of the cake, as you call it out, which I love. I love the name of the app, and I love the metaphor. So that's fantastic.
You've sort of honed in on exactly why cake exists with that. So with the listed space, the structures and the systems exist, and the mechanism for creating liquidity exists. So if you want to buy and sell stocks, you can. If you get stock in a listed company, it's much, much easier to sell that stock. But in the private space, it's extremely difficult, but it's improving all the time. And that's our mission. We have to make it much easier to invest in these companies. But if you're going to invest, you have to be able to exit. And this is a global issue. The hardest part actually is the employee equity part. People don't understand it. They're scared about it. Implementing it is difficult. And then you've got global teams, which creates even more complexity. But we are seeing a big shift globally towards acceptance of this. As you said, in the US, in Silicon Valley, it's almost every single startup has it. In Asia, they're sort of lagging behind to some degree, but it's coming through slowly. Europe is fighting really hard to catch up with the US. Australia, thankfully, we have worked extremely hard to help Australia become at the forefront, and it is very widely accepted and almost a requirement now as an Australian startup that you would have equity, and it's totally doable because of Cake. So our mission is to make it so that all startup teams can have equity. No matter where your startup teams are in the world, they can have equity. It's simple, affordable, and understandable, and that we can have exits, that we can have real liquidity. And then it becomes such a wonderful tool for wealth distribution, wealth creation. Startup equity really is worth something. One of the greatest performing asset classes of the last couple of decades is early stage investing. It's a hard class of asset to get into, and there's been incredible returns created. So I think getting into the right company is important, and there definitely are winners and losers, but an incredible amount of wealth is created in startups every year, and we have to try and educate people on how to get involved. We're pretty excited about it.
This is often known as an employee share option pool. It is often referred to as ESOP, right? Employee share option pool. So you'll hear us use those phrases interchangeably throughout the episode.
Yeah, unfortunately, every country has a different term for it. And sometimes countries have 3 or 4 different mechanisms for it. And so apologies for any technical issues today. We should try and be as clear as possible as opposed to help people understand that as we discuss it.
Let me share my perspective as someone who's been on every side of the employee equity equation. Obviously, one of the challenges with equity is the cake always adds up to 100%, right? So if you give some away, in a sense, there's less for everybody else. And so what you want to do is make sure that you are getting something in return for giving away equity to your employees. And I think there are a few things there, right? The first is to make it not too onerous to set it up, because as a founder, you have so many different things going on. If you put too much effort into setting this thing up, it's scary, it's confusing, there can be a lot of paperwork, it becomes less worth it. The second thing is, what sort of relationship do you want to have with your employees? There are stories of successful startups that don't have employee equity. But what does piss me off is startups that say, oh, we expect everyone to act like an owner of a business and, to Chris's point, to sweat blood and to really care about the outcomes for the business, but then not give anybody a piece of that, right? It doesn't seem right, but more than just not seeming right, you're not going to get that sense of ownership from people who do not have that ownership. Like imagine, you get to the point where you have your big exit, you have your IPO, and you as founders are celebrating, they're drinking champagne, you're gazillionaires and everything. Then you have all your employees around you and they haven't made a cent today. That feels wrong. And so this is an element of fairness, but also just getting people's skin in the game. And then the other thing is, how do you communicate it effectively? You want your employees to understand the value of what you're giving them.
Yeah, there's 2 mindset shifts I think that we need to talk about here. So, Yaniv, you use the phrase, why should you give away equity to your employees? And I think if you're an employer thinking of it as giving away equity, I think you have the wrong mindset, right? You're compensating your team with equity and you're driving alignment with equity. You're not giving away the equity, right? So that's the mindset shift you have to make on the employer side. And on the employee side, this idea of like, well, it's not going to be worth anything anyway, and they're just giving me funny money instead of real compensation. Firstly, there should be a cash component to a salary, particularly once the company is funded. But secondly, this podcast is certainly for startup founders, it's for startup investors, but it's also for startup employees, right? And I would say, as a startup employee, if you're working at a startup that you don't think is going to be worth anything, you shouldn't be there. You should be at a different company, right? We talked about this 2 episodes ago, I think. If the equity you're being given you think is valueless, you are at the wrong company. So why are you sitting there? Go work at a better company and invest your time, your blood, your sweat, your tears in a company that you think is going to be valuable. You're investing your time and it should be worth something.
Yeah, I totally agree with that. I mean, just to touch on the final point, one of the most recent features we've launched in Cake allows them to look forward into the future to see what their equity is going to be worth if they reach one of these huge valuations. So what happens if they're worth 200 million or 500 million, or what happens if they really smash it and they're worth as much as Amplitude or Uber? It's important that people, first of all, believe that their company can succeed, and that they understand what the financial opportunity is for them with their equity if they do happen to be one of those great companies over a 5 or 10 year period. So yeah, you're absolutely right, Chris. I think only work for startups that you think are going to win. Otherwise, move startups, or probably just get a job where you can get paid better and then you can take some of your salary and invest it like a good VC.
That's right. And if you're not telling a story about your startup having huge ambition, and you're not telling a story about how your equity will have huge upside, you're missing a trick. We had an episode about, do you really believe you're going to be great? Or are you lying to yourself, right? You need to believe it. You need to act in accordance with that belief. And then you need to give that belief to your employees. And then you need to give them a piece of that upside so that they can act in alignment with that belief. That is one of the many ways in which you make it a self-fulfilling prophecy, where your employees work a little harder, they're a little bit more invested, and maybe, just maybe, you have a little bit more chance of actually achieving that big, bold, ambitious outcome.
Definitely, definitely. Huge ambition. Make sure it's part of your narrative. It helps you get investors. It helps you build a great team, and it helps you run through brick walls as you have to do, many times on the journey. So I guess to come back to one of Yaniv's questions and extrapolate on this point, communicating. How do you communicate the value? So a standard employee equity scheme or ESOP will start out at about 10% and can grow to as much as 20%. I think the average in the US is 18% of the company's equity is within these schemes, which is a huge amount of the company's equity. And you have to be getting value back for that. So for me, it starts with the leadership, as we're just talking to. You have to have leaders, so founders and executives that believe in employee ownership. They have to believe in everybody winning, everybody having skin in the game. They have to have an internal people strategy that brings people on the journey. So when are those key communication points you were asking for? So it's when you're hiring, you have to explain, hey, this is your cash component of your salary. This is the equity. This is what it's worth today, but this is what we think it's going to be worth in 2 or 3 or 5 years' time. You have to tell that equity story when you're hiring people, because it sets you apart from other hiring companies that might not be so good at telling that story. Even just explaining to your new team members how much the founders care about their equity and that they have fair terms in their equity plan. Like, some equity plans are not fair to the team. They are actually punitive to the team and very fair to investors. And so even explaining that to new hires, I think, is an important way to build trust, and so that they really value their equity. Then when they're signing the documents, you need to answer all their questions, because they normally have a lot of questions and they can get scared in so many ways. It's incredible. I mean, even me, when I'm hiring and explaining it to people, and then they'll say things like, are you deducting this from my salary? That is totally wrong. And I'm not criticizing them because they're smart people, but like, you have to take the time to let them ask all the questions so they feel safe and engaged to it. And then the other part is, every time you do an investor update, you do the same thing with your team. It might be a slightly different set of information, but very, very similar information. Where are we now? Are we hitting our milestones? When is our next round? Is it on track? If it's not on track, why is it not on track? And what are we going to do about it? So it's important that you treat your team members like investors, so they feel like their equity is worth something, and they're much more likely to dig deep and go on that hard journey with you.
That's great advice for general leadership and management, right? Is keep your employees in the loop about what's happening, both for context setting and decision making, but also for aspiration and for alignment and all this kind of stuff. So yeah, it makes a ton of sense. So let's dig into the weeds on some of this a little bit. What are the different kinds of equity schemes, right? Options, RSUs, profit share, things like this. What's the story with all these types?
The most common form of employee equity would be an option. So in the US, would be called an ISO or an NSO option plan, can be called an ESOP. So an option gives the team member the right to buy shares down the track. So it's not actually shares. There is a payment required in the future to convert from an option to a share. And that is a little bit complex. We can dig into that a little bit, but essentially the main points on an option is, first of all, you grant the option to the team member. They vest that option along the journey. And then there's the exercise payment where it converts to shares. So that's probably the most common method.
Let me unpack that a little bit more. So when you grant the option, that is basically saying to the employee, I promise you, I'm going to give you the option to buy equity in the company. And that option has what's called a strike price, meaning the price at which you're going to pay for that equity. And that typically that price is going to be far, far, far lower than what it's worth when you pay it. So you might buy the equity at the strike price of $1, but it's worth $100. So of course you're going to make that transaction all day long, right? I'll absolutely buy $100 worth of equity off you for $1. The vesting is then, okay, you are now actually allowed to buy that amount of equity for $1.
I like to think of the term vesting as earning. You have to earn this equity, and that's called vesting. And it's either normally time-based. So do your job well over a 3 or 4 year period, and you're going to get your options. You earn them, or hit a certain milestone, and then you earn your options.
That's right. So the granting is like promising, here's the total that is going to be available to you. And the vesting is like earning, and you earn it over time. And then there are often a little bit of shenanigans that you will typically see with the vesting or the earning, which is that you earn none of it for a year because they may choose to fire you. It's like a probation period, basically. And then you earn the full first year at the end of the first year. It's called the cliff. Right. So at the end of the first year, you get your first year worth of earning, worth of vesting. And then from that point forward, you earn 1 month at a time, like it's a salary.
Totally. And it's the exercise part that is the trickiest part. I think most people kind of get the granting and the vesting, and then the exercising is like, okay, so I earned my equity and now I also have to pay for my equity. That's actually like a real trick. And people can muck that up. But as you said, normally the exercise payment is very, very small in comparison to what it's worth. That's the goal. Where it gets tricky is when the exercise payment is actually close to the value of the share. And that can happen. The other trick that can happen with exercising is that sometimes it's time limited, and the time when you need to exercise is not aligned to when you want to do it, which might be when the company's exiting or when the company starts paying a dividend down the track. So those are the two tricky things with exercising that we might want to dig into a little bit.
I think it's actually important, and a big part of what we want to do with this episode, Jason, is to demystify some of this stuff. We were talking about communicating equity effectively to employees, and also for a lot of founders who are not experienced with it. One of the issues with equity schemes and ESOP is that it is technically complex. And so people psychologically, they write it down to zero, right? To your point about like making people value the equity, they're like, I don't get it. So I'm just not going to actually value it. I'm not going to consider it a valuable part of my package. And so I think it's important to understand this stuff. Also, to make sure you're not getting screwed. But one of the things, like listening to all this, someone listening to this might think, okay, we've got all this issue with like exercise price. And yeah, we'll talk about some of those technicalities around like exercise windows and option expiry and so on. Like, why give people this fairly exotic instrument, which is a stock option? Why not just give them shares in the company? What's the reason for that?
Very good question. In almost all countries, if you give someone shares, you have to pay tax on the value of those shares at the point when you receive them. Most countries have a tax exemption for the issuance of options, which means that you don't have to pay tax until some point in the future, which is obviously beneficial because if you receive shares now, they're illiquid, and you have a tax bill now, which is cash, you've got a major issue. So in every country, you need to look for the tax exemption. And that's why these different types of equity are more common.
And we've mentioned the term RSU a couple of times, which stands for restricted stock unit. That is kind of just giving the shares. And the restriction is simply around the vesting. As you know, you want to pay people shares each month. That's an RSU. The reason they tend to be less popular in private companies, meaning those are not listed on a stock exchange, is precisely because of that taxation issue and the fact that you don't have access to liquidity. RSUs are more popular for public companies. For example, when I was at Google, your RSUs would vest and that would be a taxable event. But of course, you could just sell some of the shares on the stock market to cover your taxes. And so it became much less problematic. But options do have that tax advantage. So we have a basic structure, right? Which is generally an employee will get an options grant. And the typical vesting period is 4 years, which means you get paid a little bundle of options over those 4-year period. After that 4 years, if you're still employed there, that full grant is vested. And as Chris says, often the first 12 months, you don't vest anything. And on your 1-year anniversary of the grant, you get a quarter of the options and then the rest of them monthly or quarterly. So that's the basic structure. Now, there are a couple of other things that I think people should be aware of on the more technical side that we should talk about. And one that you've already hinted at is the question of option expiry. Maybe you could tell us a little bit, Jason, about option expiry and what the implications are there for employees and perhaps for a founder, how you would recommend thinking about option expiry.
Yeah, so option expiry is also called the exercise period. So at the end of the exercise period, the options expire. And globally, there's a wide range of common exercise periods, anywhere between 3 years and 10 years. They can be unlimited. We do advocate for that. But in my opinion, to set up an employee share scheme correctly, you want to have as long an expiry date or an exercise period as possible, because what that does is it allows the team member to align their exercise to the major event, which is normally the exit. Normally, there's no real reason to exercise an option other than to access an exit or a dividend. And most startups don't pay a dividend until years 5, 6, 7, 8, 9, 10 anyway. And most exits occur years 5, 6, 7, 8, 9, 10. So you want to align your team's ability to exercise to those major events as much as possible. Why do you want to do that? Because they have to pay their own cash to exercise, and it's a very risky asset. So what you're asking them to do is, first of all, earn the equity, then make a cash payment in a very risky asset when these major liquidity events have not occurred, which in my opinion massively misaligns that exercise with the reason you own that equity in the first place.
So you've talked about exits and liquidity events. These are all fancy terms for when the company gets sold to someone else for money. Lots and lots of money. And so the shareholders of the company get that money, right? It gets distributed to all the owners of the company. And as an option holder, you have the option to own the company, right? And so there's no reason to exercise that option, to take that option to buy a piece of the company at a cheap price, unless and until you're going to get paid even more money from the person buying the company, right? And so you want to organize your options such that the employees can exercise the options, can buy a piece of the company and then sell it straight away back to the person who is buying it for a lot of money. They're going to do that after 5, 7, 10 years. So if you say, here's an option to buy a piece of the company for cheap, but you have to buy it in the next 24 months. It's like, well, I don't know what the hell's, why would I do that? In 24 months, the company is going to fail, succeed. I'm going to give you lots of money and I don't know if it's worth my while. What you want is to say, here's an option to buy a piece of the company. We're giving it to you as an option because it's tax efficient, right? You don't get taxed. And you'll be able to exercise that option. You'll be able to buy a piece of the company at the same time that we're selling the company. And so a new owner is buying your little share for hundreds and hundreds of dollars, and you only have to pay us $1. So you pay us $1 and you get hundreds and hundreds of dollars back. That very same moment almost, right? And then you pay your taxes out of those hundreds and hundreds of dollars. And so multiply that by thousands, right? It's hundreds of thousands or millions of dollars.
So this is the type of wealth creation that we want to see from equity. But let's talk about a bad situation, right? So you earn your $40,000 worth of equity. You've got a 2-year vesting period. So you work for 3 years, you earn your equity. You don't exercise your options because there might be a $5,000 exercise payment required. And you're thinking, geez, this company's looking super risky. I don't want to add another $5,000 into this company. I've already worked there for 4 years. So you don't exercise your options and then they lapse, right? So they're worth zero. And then 4 or 5 years later, the thing lists on the NASDAQ at like 600 million and you've just burnt, 800,000. We do not want to see team members earning equity in startups, having an arbitrary exercise period and then missing out on these huge life-changing events. That's what we're trying to avoid here.
Yeah, I actually feel real strongly about that one. And I completely agree with you. I do think sometimes there are these ESOPs that are set up to be quite employee unfriendly. And to me, that's a real breaking of the social contract between the employer and the employee when it comes to equity. And this idea of like, oh, okay, if someone's left the company, we should clean them up off the cap table.
Oh, I hate that.
And it's like, no, you've earned that equity fair and square. That person, for the period that they were at the company, helped the company to get to where it is, and they should share in the upside. And, the reason we give options, as discussed, is not so you can screw employees, it's for tax reasons, right? So do not set up an ESOP where you try to claw back, right?
Like, I'm happy to say, get off Cake. If you're a customer of Cake and you're doing that, get off. Like, seriously.
There you go.
Yeah.
If you're listening...
Cake customers care about their teams. Like, we do not want to see crap like that. Now, look, unfortunately, in very bad situations, like cap tables do get crushed, and there are preference stacks. And I'm not here to say, like, we're all living in this fanciful world where there can't be bad outcomes. There can be bad outcomes, but we want to see founders and executive teams and investors supporting their teams and helping people as much as they possibly can.
As a startup founder, you cannot let yourself get distracted with the everyday admin of running a company. That's where today's sponsor Deal comes in. Deal's all-in-one HR platform does all the work of running a global team for you, so you can focus on changing the world. Go to deal.com/TSP to learn more. This episode of the Startup Podcast is brought to you by Until Now. From brand and product design to product management through to go-to-market and product strategy, Until Now lets you augment your existing team with the skills required to achieve the best outcomes for your startup. So check out their work and get in touch at untilnow.com.au.
So let's now tell the full story end to end, right? So what typically happens is an employee joins the company. They are granted options, which is like a promise of how much equity they're going to get. And the reason they're options to buy equity is so that there's no tax. The agreement is part of their overall compensation package. It's part of the consideration you would make when joining the company. Now, these options should be at a low strike price. They're, let's say, for the sake of argument, $1, with the expectation that the value will be many, many, many times that later. And they should ideally be with a large option window, meaning they won't expire for a long time. You then vest these options. As we've said, that's basically earning them. You earn them after the first year, you earn your first year's worth. And every month after that, for let's say about another 3 years, typically, you earn your options. As you're going, the company may raise more money, and that dilutes you. So the piece of the cake you had, well, someone else just went and got some more of the cake, right? And so your little piece gets smaller. That's called dilution. So the cake gets bigger, but your slice of the overall 100% gets smaller. So the value you're holding is worth more, even though it's a thinner slice. Then at some point, the company hopefully will exit, as we've said, as a fancy word for selling itself to someone else. At that point, you exercise the options, you buy the equity, the acquiring company gives you cash money for your shares, which is hopefully many, many times the price you paid, and then you pay taxes out of that nice money that landed on your lap, that payment that the acquiring company pays you. And so that's the journey of options and ESOP for an employee, at least the happy path, right? There are all sorts of unhappy paths, but that's the intention.
Unfortunately, sometimes we drop that cake on the way along and we go jump and we get another piece of another cake.
That's right. That's right.
Cake gets moldy. So far, we've talked about how equity schemes work and why we think they're a good idea for a lot of founders to give equity to their employees. But one question, and it's one that I've struggled with myself as a founder, is actually the question of how much, right? Because when you move from the binary of, okay, we don't give equity to we do give equity. And then the question is how much equity to give away, and how to think about that is actually complex, both for the employer and then also for an employee considering their offer. Like you said, a typical size of an equity pool might be 10 to 20% of all of the shares in the company. But you're not hiring people all at once, right? You're hiring people one by one. There are different levels of seniority, different levels of importance to the business. How do you actually think about what is a fair and good amount of equity to give to each employee?
Great question. And thankfully, we're getting more and more data on this all the time. I think if you go back a couple of years, like it was just a big black box and it was really, really tough. So let's talk about a few use cases, because I think there's so many different people that you need to incentivize with equity, and there's also different stages of the company. So let's start with very early stage companies and work our way along. So quite often, the first time you need to issue equity is your first couple of hires. So just say you've done a seed round, you need to hire 2 or 3 people, and you're like, well, okay, how much equity do I give? So these are your first few hires. These people would normally get a bigger piece of the cake because the company's very small. And normally you're trying to minimize the amount of cash that you're spending. So you're trying to get really high quality people into a very risky company, and you need to be able to give them some real skin in the game, and you don't want to pay them too much. So look, as a rule of thumb, these people quite often get around 1%. Like if you wanted to do it very simply, you could just say, hey, give the first 5 hires 1%. It's very, very simple. I like to do a bit of a calculation and be as financially minded as much as possible. The one thing I help founders in the early stages is just say, hey, look, what's the company worth? And then give that person a percentage of equity on top of their salary. So if they're getting $100,000 a year, are you going to give them, say, 20% on top of their salary? Is it 30% on top of their salary? So they're earning $20,000 or $30,000 a year over 4 years. If you turn that back into a percentage, it's quite often somewhere around 1%. It's a nice way to articulate it.
Just to be very clear about that, Jason, what you're saying is if they're earning $100,000, you figure out we want to give them 20% over the top of that as equity. So that's $20,000 on top of their $100,000 cash. We would pay that as equity, which means $20,000 worth of equity based on the current valuation of the company. Just to be very clear on that.
And you can call it equity because it's not stocks or shares, but it is still options, which is part of your equity. It's part of your cap table. So that's how I would calculate it. I'd like to try and instill this level of discipline in seed stage companies as much as I can so that they're quite clear and they're starting to build that financial discipline into the way they manage their equity. And then that builds up over time as they get more sophisticated, they get bigger, the valuation of the company increases, and they get better and better finance staff and so on and so forth. The other thing you normally need to do right in the beginning is get an advisory board or do sweat equity. And I love seeing early stage startups using their equity in that way. You have a very short runway. You've got a lot to achieve. You've raised very little. And so we advocate using the Founder Institute FAST agreement for issuing advisory equity. It's a big and common mistake for founders to give sweat equity and advisor equity way too much. They give away way too much, and then it's very hard to claw it back. So you want to use the Founder Institute FAST. It helps you understand exactly how much equity to give, and it's normally like 1% or a fraction of a percent, and it's earned over a couple of years. And that's very beginning. Some ways to issue it: first hires, advisory equity, sweat equities. That's kind of day 1, day 2 stuff. And then once you're scaling up, sort of seed stage, Series A stage, they're really starting to get some high quality benchmarking data out there. We have this built into Cake now. So we've got thousands of data points, and there's other reports out there and providers out there that we're starting to get tens of thousands, if not hundreds of thousands of data points. So we can help you understand if you're seed stage, if you're Series A, if you're hiring a tech role or an HR role or a marketing role, and if it's senior or junior, like what's roughly the benchmark for equity. And it helps give confidence to those hiring and issuing equity that they're issuing in the right range and therefore being competitive in the market when they're hiring, and or not giving away too much because you need to protect your equity as well.
One thing when I'm pitching employees on the equity package that I'm offering them is I think there is the value of the equity. But remember, what we're talking about in general here is illiquid equity in an early stage company. So if you're getting equity in a company at a valuation of $6 million or $15 million, the one thing that is nearly certain is that you will never be able to sell that equity at that valuation. It will either go much, much higher or it will go to zero. And in a sense, and this goes back to Chris, what you were saying earlier on, what you as an employee need to figure out is your own personal probability distribution. It's like, how likely do I think this company is going to be worth $1 billion? How likely do I think it was going to be worth $500 million? How likely do I think it's going to be worth $100 million? And what outcome do I get in each of those cases? And overall, does this look like a good deal to me for generating additional wealth beyond my salary?
I love that.
And so that's very personal because no one knows the future, right? But it ties into that sense of, do I have conviction in the company I'm joining? And if you don't have conviction in the company you're joining, then you probably shouldn't be joining it, because that's sort of the startup game, really.
I love that. Just think about what your founder's pitching to investors. They're pitching that they're going to be able to double the value of the company every year for the first 3 or 4 years. And then after that, at least 50% every single year. That they're going to be able to double or triple their revenue every year for the first 5 years or more. If they can't convince high quality investors to invest in them, then you should be wondering what you're doing there. Unless, of course, you have a very keen insight into that industry, or you know something about that industry or that space where you think you can make that call that you guys are like really onto something. And so you should be looking at the key people in the company and the other investors around that company all the time going, hey, is there some bloody smart people with a hell of a lot of skin in the game here, or should I be jumping ship?
Yeah, that's the thing I love about employee equity is not only does it work to motivate your employees to do a better job, it also works to hold leadership to account. They have to be competent and effective in order to retain the best employees. And so it's this beautiful alignment game that drives efficiency and quality of execution that other companies cannot benefit from if they don't have equity programs or they're big and mature and they're not growing very fast. You know, Yanev, you and I, we talk about the magic of startups. This is one of the ingredients of the magic, right? I think one of the ingredients is that the founder's in charge and they can turn things around like a speedboat. The other is this big, bold ambition, this little bit of defiance of gravity. And I think maybe a third big ingredient to the magic is this equity program that kind of only works when the company is on a hockey stick curve, right? Where the value creation is just so interesting. And you get really incredible people working incredibly hard to create incredible value over an incredibly short period of time. And that's just thrilling. It's thrilling. There's nowhere else you can really see that happening.
It is thrilling. It's exciting. Building great teams, solving huge problems, having massive outcomes. I mean, that's what the best people want to be doing. And we're competing for talent and we're competing for mission. And that's what we want to see. We want to see people jumping ship to a better, bigger mission. This is a key ingredient, I think, to building a great company.
One other thing that I wanted to ask about, Jason, I think it's really important, and this is more from the founder side, is alignment with investors, right? Because cap tables are one of those things. Like I said, there's two ways of viewing the cake, more traditionally called the pie, right? The two things that are true about the pie. One is that the total ownership of any company always adds up to 100%. And so there is a zero-sum way of viewing this, right? Is that if I give you 1%, I own 1% less, which is true. But then there's also the abundance way of viewing it, which is the aim isn't to fight too much over how big the slice of the pie is, but to grow its overall size. One thing that's really important, and you were right to call me out before, you're not giving away equity to employees. You are paying equity to employees. But that does come onto the cap table. It does, in a sense, dilute the other shareholders. And so how do you think the right way to approach managing investors and getting investors aligned with the importance of an ESOP is?
Again, I think it comes back. I mean, hopefully I don't sound like a broken record, but the company and the founders and the executives need to show the investors that they're using their equity in the right way. So we're using our equity to attract better people and we're using our equity to engage that team. So we're communicating with them. We're making sure they understand it. We're checking for red flags. We're checking for disengagement. So we're attracting, we're engaging and retaining high quality team with our equity. So that's what we need to be communicating to investors. So that could even be separate updates to your investors about those activities and those behaviors and how you're actually best in class in the way you're managing your equity and your employee culture. The worst possible outcome is that 10, 20% goes out the door and there's no benefit. Like that's a tragedy. You might as well not do one at all. So yeah, I think communication goes both ways and stakeholder management goes both ways. So as a founder, you want to be communicating to your investors that there's real value in this scheme. And to your team members, you want to be communicating that the investors and the founders and the executives are behind them and supporting them all the way. So there's this balance that needs to occur between the sides.
Maybe send them a copy of this episode where we could talk about aligned incentives and holding everyone accountable. So let's talk about a few things to watch out for, Jason, in the final few topics here.
Yeah, so I think look for a company that cares about its equity. You should be able to tell that from the hiring process. If your company's not doing updates, if they're not telling you what your equity is worth, if they can't answer simple questions about what you own and what it's worth and what's happening this year and where the valuation's at this year and next year, like I'd be seeing that as a red flag and I'd be looking to try and find a company that can answer those questions.
In other words, if they're not using cake.
Yeah. For me, it's all about, does your company or the company you're signing up for have an employee ownership culture? Do they care? Do they communicate well? Are they going to support you on the journey? Those are the big things. If you're working for a global company, which we're huge advocates for, and more companies are going global and having global teams, you can now expect equity no matter where you are. And that's the cool thing. So there's more and more choice for people all around the world to participate in equity programs, whether it be based out of Singapore or the US. Don't feel scared just because you're part of a remote team to ask for equity. It's getting more and more fair and doable all the time.
Jason, this is going to be a softball question now. I think you'll know the right answer. How does one set up an equity scheme for their employees?
Do not reinvent the wheel. This stuff should not be complex. Equity for startups is standardized and streamlined. We don't want to see founders wasting time in lawyers' offices, learning complex legal agreements and mumbo jumbo jargon. It's hell. And you can't understand it anyway. Like you can't literally, like I'm a 20-year finance professional and it is so complex. We need to streamline and standardize so that founders can go on and change the world and build great teams. You should use Cake to set up your employee equity. At Cake, literally, it's like just a few clicks and you have all the legal documents, all the vesting. Everything we talked about today is 10 times easier if you're using Cake. And this is not a joke. We've been working with this for 5 years. So whether it be setting it up on day one, attracting, engaging, retaining talent, it's just an absolute godsend for people that are doing that.
I want to clarify a little bit actually what you're saying, which is it should be standardized and there is a standard best practice way of doing it. But as you said, if you're finding yourself talking to lawyers and inventing stuff, then you're off the beaten track. Kidding aside, whether it's Cake or one of Cake's competitors, you need a tool to make this easy to set up and easy to manage. And the point is not just the setup. The point is the employee communication and engagement. It's the management over time. It's the shifts and changes as new equity gets assigned. And so you need a tool that allows you to calculate that and communicate that to your stakeholders. And so this is no longer a legal problem. It is a business management problem and a communication problem. The legal part should be, there is well-worn best practices that are now codified in software. And so, as I said, jokes aside, our biases aside, Cake or a tool like it is, I would describe it as almost essential.
There's two aspects to having an effective equity scheme, both of which we've covered in this episode. The first is the mechanics, the cap table management, the legalities of the scheme and so on, and getting that right. And yes, you shouldn't need to roll your own. You shouldn't need to get a lawyer. You should use something off the shelf. But another part of the evaluation is to consider how you communicate effectively to your employees the value of their equity. How do you have a portal where people can track their vesting, can play with different valuations and so on? As somebody who's been on the employer side a few times now, the hardest thing about having a really successful equity scheme is to get your employees to genuinely understand and value this thing that you're giving them. Because if they don't value it, then it's going to put more pressure on the salary negotiation. It's going to make them less satisfied. And you're just not getting full value as an employer from that ownership that you are granting your employees.
That last point, Yanev, is very important, right? If you're doing a share equity scheme and you are not communicating it clearly, you are wasting that equity, right? You're giving something away and getting little to no benefit from it. So it's just the worst of both worlds.
Building your equity value and using your equity, unfortunately or fortunately, is one of the most complex things a founder has to do. We don't have a finance background or a legal background, but you've got to use it when you're raising. You've got to manage your dilution. You want to maintain enough of it. You need to use it for your team. It's just a major part of being a founder and a startup. And it is in two parts. I love that you said that. There's the people part and the communication part, whether it be an investor or a team. And then there's the technical, financial, and legal part. And if you don't work on both those pieces, then you're just not going to have a high quality outcome.
Well, I think that's probably a good place to end it. So Jason Atkins from Cake, thanks so much for joining us and for sharing your wisdom around employee equity. Folks, I hope this was a really useful episode for you that uncovered the mechanics of a pretty complex and important part of the overall startup journey.
I'm really grateful to be here. Thanks so much for having me on. We're very passionate about what we do and we got to stick a few Cake plugs in there. So thanks for that and good luck on your founder journey.
Awesome, guys. Now, remember, if you've listened to even just a few of our episodes and gotten value out of it, you've implicitly signed up to the Startup Podcast Pact, which says, please spread the word about the show on your favorite social network, subscribe to us and rate us in your favorite podcasting app. It helps us grow the show and help more founders. Really great to chat. As always, thanks for joining us, Jason.
Thanks for having me.
Cheers. Have a good one. Today's episode of the Startup Podcast was brought to you by Deal, the all-in-one HR platform for global teams. Deal are growing incredibly fast, and that's because of the amazing flexibility they provide. Go to deal.com/TSP, that's DEEL.com/TSP for the Startup Podcast to learn more. This episode of the Startup Podcast was brought to you by the team at Until Now. Until Now's experts work alongside you and your team, which means that they level you up as they go. I've worked with these folks at Airtasker, and they're behind the recent fantastic rebrand of this very podcast. They are the real deal. Check out their work and get in touch at untilnow.com.au. That's untilnow.com.au.